If you've ever watched a financial film or heard traders talking, the word leverage comes up a lot. It sounds powerful, and in a way it is. Leverage in finance means using borrowed money to try and amplify your returns. Instead of only investing with the cash you have, you borrow more, and that borrowed capital boosts the size of your position. If everything goes right, your profits look amazing. But if things go wrong, leverage can destroy you faster than almost anything else in finance. That's why leverage is often called a double-edged sword. In this video, we're going to be discussing leverage in more detail. Please do subscribe if you haven't already. It really helps this small channel grow. The idea is simple. Imagine you have $1,000 to invest. If you buy shares with just your own money, your maximum gain or loss is tied to that $1,000. If the stock you buy goes up 10%, you make $100. If it goes down 10%, you lose $100. But with leverage, you can borrow, say, another $1,000 from a broker. Now you're controlling $2,000 worth of stock. If it rises 10%, you make $200 instead of $100. That feels great, but if it falls 10%, you've lost $200 instead of $100. Suddenly, you're 20% down on your own capital. The gains are magnified, but so are the losses. That's why leverage is so tempting. It makes the upside look incredible. You don't need to be Warren Buffett to double your money if you're using enough borrowed funds. But the problem is that the same math that multiplies your gains also multiplies your pain. If the trade moves against you even slightly, leverage can wipe out your investment. That's not just theory, it happens all the time. Take margin trading, for example. This is one of the most common ways retail investors use leverage. A broker lets you borrow money against the value of your account to buy more stocks than you could afford otherwise. But here's the catch. If the value of your investments falls too much, the broker issues a margin call. That means you're required to deposit more money immediately, or the broker will sell your positions at a loss to cover what you owe. Countless investors have been wiped out because they didn't fully understand how quickly losses compound under leverage. It's not just individuals either. Entire companies, even countries, have been bought down by leverage. Think about the 2008 financial crisis. Banks and hedge funds were heavily leveraged, sometimes 30 or 40 times their actual capital. That meant even a small decline in mortgage-backed securities set off catastrophic losses. A 3% fall could wipe out 100% of their equity. The system was balanced on a knife's edge, and when things turned bad, the collapse was unavoidable. Leverage isn't necessarily evil though. Used wisely, it can accelerate wealth building. Businesses use leverage all the time when they take on debt to expand. A company might borrow millions or billions to build a new factory, hire staff, or launch products. If the business succeeds, the borrowed money allows it to grow much faster than it could have using only profits. Homeowners use leverage when they take out a mortgage. You're borrowing hundreds of thousands to buy a house with the hope that over time the property appreciates in value. Without leverage, most people would never own a home. The difference is that in these cases, leverage is usually tied to long-term assets with tangible value, like real estate or productive businesses. The danger comes when leverage is used for speculation, short-term bets on stocks, crypto, or derivatives. That's where you see people getting completely wiped out because the volatility is too high. When you're leveraged, volatility is your enemy. Even a temporary dip can trigger forced liquidations, margin calls, or total ruin. To put numbers to it, let's say you have $10,000. If you invest it without leverage and your asset drops 20%, you're down $2,000. This might be painful, but it's manageable. Now imagine you used 5-to-1 leverage, borrowing $40,000 on top of your $10,000 to control $50,000 worth of assets. If those assets drop by just 20%, that's a $10,000 loss. Your entire capital wiped out. You're broke and you still owe the lender. The same 20% move that was survivable without leverage becomes a disaster with it. This is why professional investors talk so much about risk management. Leverage isn't just about amplifying returns, it's about controlling how much risk you're willing to take on. Hedge funds, banks, and even small traders use tools like stop-loss orders, position sizing, and diversification to try and survive in a leveraged environment. But even then, history shows that sooner or later, excessive leverage blows up even the smartest players. There's also a psychological trap with leverage. Success early on makes people overconfident. If you make a big win while using borrowed money, it feels intoxicating. Suddenly you think you've cracked the code, and you start pushing harder, borrowing more and chasing bigger returns. But markets are unpredictable, and sooner or later a bad trade comes along. If you're leveraged, that one mistake can erase years of progress. This cycle has ruined countless traders. The irony is that some of the greatest investors in history are famous not for using leverage, but for avoiding it. Warren Buffett has often said that leverage is unnecessary and dangerous. His company, Berkshire Hathaway, rarely takes on significant debt relative to its assets. Buffett's view is that you're already investing in things that compound wealth over time. You don't need to borrow to accelerate it. Patience beats leverage in the long run. But in the short run, leverage will always tempt people. It's human nature to want to accelerate wealth, to get to the finish line faster. And as long as markets exist, people will continue to take on leverage. Some wisely and some recklessly. The important thing is to understand what leverage really is. It's not free money. In small, controlled amounts, leverage can be useful. In large, uncontrolled amounts, it can destroy everything. The next time you hear someone bragging about doubling their money with leverage, remember the other side of the equation. The same tool that made them rich could also make them broke. The question is whether they understand the risks, or whether they're just another margin call waiting to happen. Have you ever used leverage to try and accelerate your wealth building, or does the risk outweigh the reward for you? Let me know down in the comments, and please do subscribe if you've enjoyed this video, and thanks for watching. Why not consider watching this video next? If you have an interest in tech as well as finance, I've left a link to my other channel down in the description.